So again, welcome everyone. I'm Claire England. I'm the moderator and host of this session. The real hosts are, or the organized hosts are StartupNWA and the Northwest Arkansas Council. We're going to go into a panel discussion in 10 or 15 minutes with our special guests, Carter Malloy with AcreTrader and Matt Tarver with RZC Investments. But first, I want to tell you a little bit about how we got here to this series. Again, we're hosted by Startup Northwest Arkansas and the Northwest Arkansas Council. This is the second in our series. Last week, we talked about pivoting during a crisis. And I also want to note that next week is our final of this 3 sessions, and that is Invest During a Crisis. And we're just announcing that our special guest will be Susan Mason with Aligned Partners. She's a very, very experienced venture capitalist based in the Bay Area, and I encourage everyone to join us next week or be sure to watch the video once we release that as well. Again, I'm Claire England. I'm based in Austin, Texas, and our panelists are up in Northwest Arkansas. This is a program, of course, based in Northwest Arkansas, but I am working with the region on a very important project. I'm also a partner in the FemTech Fund for Portfolio Venture Funds. I'm a Kauffman Fellow, which is a network of VCs who've gone through a postgraduate 2-year program. And I help regions build out their investing communities, which leads me to what I'm doing here. Last fall, I led a project to research angel investing in Northwest Arkansas. My first phase was interviewing more than 50 startups, business leaders, and angel investors in the region. I shared best practices and tools for implementation for developing a new angel investing effort in the region. Some key findings, for those of you from the region, you'll know these well, but we do have folks joining us and who will be watching the video who don't know Northwest Arkansas. One of the biggest strengths of the area is that there are 3 Fortune 500 companies between Walmart, Tyson Foods, and J.B. Hunt. That provides a substantial number of experienced executives and deep, deep expertise in retail tech and consumer goods and supply chain and logistics. There's a major state research university, which is critical for a potential entrepreneurial hub. And the region has done a lot to develop, starting with an airport and now world-class bike trails, a world-class national art museum, and a real eagerness for startup development and entrepreneurial success. I think what's really special about the region beyond all of that is that there is a high level of dedication and affection for the region, and it's extraordinarily friendly. Of course, every region has challenges: investor experience, investor fatigue, entrepreneurial experience, tech talent. These are very common across a lot of nascent but growing ecosystems. Fewer exits than one might see in the Bay Area or Chicago or Austin. So none of this is a surprise. There certainly was an angel group in the past, but it was not a typical angel group in that it wasn't restricted to just accredited investors. And the recommendations out of that project are, the number one is education. There are, with all of the executives in the region, and of course, for those who don't know, Walmart required all of its vendors after 9/11 to have a presence in Northwest Arkansas, an office there. So that brought even more leaders and executives to the region who have expertise in these sectors. And the only thing lacking really to getting these folks involved in the early stage investing asset class or startup investing asset class is education and awareness. So that is where we are today. This is, again, the first in a series of what will be a lot of great education to come for accredited investors and some community workshops like this. And then once the region does build a new angel investing community based on that education, the deal flow will largely be from out of state in the first years because of the nascent ecosystem. It's incredibly important, especially with new accredited investors, that they see success in their investing, and geographic diversity is key to that, as is sector diversity and a lot of factors. So that brings me to the topic of today. Again, we're talking about raising during a crisis, and we've brought in some great folks who are local to the Northwest Arkansas region, and I will get to them in a moment, but I want to talk a little bit about fundraising in tough times. Those of you who are entrepreneurs or aspiring entrepreneurs who haven't yet fundraised may not know all of this. You've probably heard it from your peers, but fundraising is incredibly arduous. It's really difficult anytime, much less during global crises. And it is practically a full-time job for the founder and CEO. And I don't know, I don't see Carter nodding, but I think he can probably attest to that. It's taxing for a small team with an early stage startup. The CEO, the team, maybe as few as just several people, half a dozen, and taking away the full-time CEO from probably 75% of his or her work on the startup is tough for the team. And of course, as an entrepreneur, a founder, you're selling some control of your company. I hear a lot of founders like to say they're giving up control. Well, no, you're not. Yes, you're giving up control in the sense that you will not have complete control of your company anymore, but it is a trade. You are selling a stake in your company. Successfully raising round can be a really good thing for you. It's certainly a chance to scale your company much faster. It's a great opportunity to get help. Angel investors and early stage VCs can bring new advice, new connections. They help you potentially, especially in a seed round, build your first board so that you have a professional board and can start building out your company from that perspective, and provide countless, if they're really good investors, they're going to provide countless access to more resources and support. All you have to do is ask them and develop that relationship for that. So what's changing in fundraising right now is fewer deals and less money. PitchBook has recently released their findings for the first half of the year, and we've seen not a massive decrease, but it is a decrease nonetheless of almost 10 billion in investing nationwide by VCs. Now, I would venture to say, PitchBook didn't say this, but I think it's safe to say that those numbers were higher than they might otherwise be because those reflect deals that were already in process or fundraising rounds that were already in process in Q1 or Q2. So what many of us in the industry are guessing is that it will likely drop more, if not significantly more, for Q3 and Q4. Now, why is that? For VCs, a couple of reasons. One, almost every VC and micro VC I know of turn their full attention to their current investments. They're ultimately responsible to their LPs, the limited partners who've invested in their fund. So they need to make sure that those investments survive this time. And they've been working on helping triage and salvage those companies and figuring out, okay, which ones can make it through this, which ones might make it through this, and which ones really probably have to shut down. And where do I put the majority of my attention? How do I help them through this time? Whether that's getting loans or the PPP from the government, there are so many aspects to surviving a global pandemic, which is new to most of us, or all of us, and a global economic downturn. And then, of course, there's the market uncertainty. Startup investing is an extraordinarily high-risk asset class for both VCs and accredited investors, individual investors. So many of the individual angel investors, the family offices, and those LPs I mentioned, the fund of funds and The major investing groups who invest into VCs are dialing back their investing due to market concerns. And all of this is information I've learned from the Kauffman Fellows. We've had several virtual gatherings over the last few months to discuss and figure out how we can best help our companies and our portfolios as investors, and what we're facing as investors in this time. So I think as an entrepreneur, particularly for those of you listening live or to the recording, it is important to understand the mindset of investors during a crisis. Similarly, angel groups are reporting significant differences in investing at this time. The Angel Capital Association did a survey of all of its member groups, had a great response from those groups, and they found that cumulative investing is down about 50% in Q1 and anticipated to be down 60% for the rest of the year. But most groups still reported they're investing. They're just investing less. They're likely to be much more selective even than they were. And it's already tough to raise funds as it is. It's just gotten tougher. Investors, similarly, angel investors are focused on their portfolio company needs. They've been contacted for help with PPP loans by their entrepreneurs, advice on reducing burn, raising follow-on, and many, many other things that those entrepreneurs need help with. And in these cases, many seed rounds are filled by angel investors and oftentimes led by angel investors or angel groups. So these companies turn to those individual angel investors for help during times like this, just as the portfolio companies in a VC fund would. And interestingly, they're reporting two different things about their portfolio companies, and both have very similar numbers. 80% of portfolio companies have reported layoffs, at least a few, if not more. And yet 80% of them are also trying to expand market share during this time, to find the low-hanging fruit, whether it's pivoting to a new market or a new product, or expanding what they're doing because they see opportunities in logistics or food supply or medical. And finally, early stage valuations are dropping. And this is not a surprise. We see this every time there's an economic downturn. So I think as entrepreneurs, founders need to be aware of this and be pricing their rounds appropriately, given that potential drop in especially early stage valuations. That's what we're seeing so far. Less movement on the later round valuations, but I think that's an important point as well. So that brings me to our panel. And I finished a minute early. We're doing well on timing here. I want to introduce Carter Malloy and Matt Tarver. Carter is founder and CEO of AcreTrader. Matt is a partner at RZC Investments. And I will take myself off of screen share and give them both a chance to introduce themselves. Stop sharing here for a moment. All right. So again, welcome to anyone who missed the opening of our discussion here, and we're really happy to have you. We're hosted by StartupNWA and the Northwest Arkansas Council, and we are discussing raising during a crisis. Matt, Carter, thank you both for being here and being a part of this panel. Do you mind, if you will, just give us a quick intro, your elevator speech for both of you, and tell us what your respective companies do.
Absolutely. So I'm Carter, work with AcreTrader here. Put simply, AcreTrader is a farmland investing platform. So farmland as an asset class is actually a $3 trillion plus asset class here in the US alone, and has put up some really incredible historical investment performance. Unfortunately, for most, that in order to get access to that asset class would require you to go out and put down $1 million to buy a farm and then manage it. So said differently, it's a non-starter. So we built AcreTrader to reduce that complexity, to make it where somebody can come online and inside of 5 minutes invest $10,000 in farmland as opposed to $1 million. And all that's done electronically inside of our application. The way that works is fairly simple. We take a unique parcel of land, we put that inside of an LLC, and a unique LLC to that land, and allow the investors to buy shares of that. And so we are a couple-year-old company, and as we're here to talk about, just raised a round of funding earlier this year.
Thank you, Carter. Matt?
Guys, hope all is well this morning. Everybody's these times as best as possible. RZC is a direct investing fund.
Matt, your sound is cutting out.
Hear me now?
Yeah, I think that's better.
Sorry, we're on Dell's, so forget.
Hey, that's an Austin company. Don't knock it.
RZC is a direct investing fund founded by Stuart and Tom Walton, third generations of the Walton family.
Still cutting out.
What about now?
That's better.
I'm going to talk into the microphone here, so forgive my ugly mug coming to you widescreen. So RZC is a direct investing fund founded by Stuart and Tom Walton, third generation of the Walton family here in Northwest Arkansas. We have a fairly unique mandate that invests across all life cycles of businesses, both from venture and growth equity all the way through buyout and distressed. Another unique characteristic of our capital is that we would like a good chunk of our investments to impact Northwest Arkansas. Northwest Arkansas is near and dear to Stuart and Tom. It's where they grew up. It's where they call home. And so they wanted to really impact Northwest Arkansas in some kind of way, whether that's through IP, knowledge curation, employment, or plays to their passions or strengths of the region and its population base and skill set base. While most of our investments are private, we do have a few notable exceptions to that, such as AcreTrader, Rafa and Allied. For those who have joined the call from Northwest Arkansas, you can likely pick up a theme on those last two. We absolutely love the cycling space, and it really aligns itself with some of their philanthropic investments on trail building here in Northwest Arkansas. Relatively industry agnostic, check sizes really depends upon the asset class that we're investing in. And venture within the region, we'll write smaller checks like we did into AcreTrader, and growth equity buyout checks. It ranges all the way from $20 to $250 million or so. So that's a little bit about us. We're a small team here in Northwest Arkansas. If you're on the call, you're in Northwest Arkansas, you probably know several of my colleagues, Don Huffner or Mason McNeil. And if you don't, feel free to reach out.
Great. Thank you, Matt. A quick note to those who have joined us live. Again, this is primarily a pre-recorded session, but we do have some folks who joined us live, and there will be a chance for Q&A towards the end of our session for the last 15 minutes or so. And I encourage you to drop your questions in the chat or raise your hand in the question section and drop your question there. And we can bring you up live if you do have a question at that time. So Matt, Carter, together, as Carter mentioned, you closed a round earlier this year. I believe you said it was in March. That was a $5 million seed round. RZC Investments led the round along with Revell Partners and private investors. Was this a new business relationship for the two of you? How long have you known each other before this fundraise and investment?
Carter, you want to take that?
Sure. So I'd say Matt and I were friends first. We got to know each other a year and a half ago plus probably. So whenever we both sort of came back to the region, I'm from Arkansas, but in similar times, and our paths crossed and had some mutual friends, so got to know each other. And then we had raised a little bit of investment capital for AcreTrader previous to this round through a safe investment round. And I invested in the company inside of that as well. And so Matt and I got to know each other and had a good time getting to know each other and talking about all the random stuff that we still do. And I think, when we decided, hey, we're going to go to market and raise a little more of a real round, we had started the discussion then. I think that was 6 months or 8 months before we actually closed. So it was certainly a long process for a lot of reasons we can get into, but a friendly one and a fun one.
I think that's pretty standard for fundraising to take quite a long time. It can take up to a year, if not longer. Entrepreneurs are Often, first-time entrepreneurs who haven't raised funds before are often surprised to learn just how long it can take. And you have to really plan for that with your business and make sure you have the runway and the burn rate, right? So thank you, Carter. You had already started raising this round before the pandemic. Can you walk us through how far along you were and your fundraising activities prior to February and March?
Sure. So I would say we were very far along. The pandemic did not have a large material impact on our fundraising. However, with that being said, if we were in market today fundraising, I think that the message would be very similar, right? And for VCs, while you're right, a lot of them are doing triage right now and working on existing portfolio companies. What they tend to look for is vision and team, right? Mm-hmm. Is this a big market? Does this company solve a real problem? And are there a group of people here, a cohesive unit, that can actually execute against this? So the amount of funding is down. That might actually be a good thing, because I think, Claire, as you probably know well, there was a lot of good money chasing after bad, and a lot of not
especially in the later rounds.
That's right. And so the absolute dollar contraction you showed from whatever 73 to 64 billion, I would surmise there that a lot of that is due to later round companies that were not necessarily great ones, nor did they have a real path to profitability at any point. And so, I still think that there are plenty of VC firms that want to deploy capital and that are looking for good ideas. And it is important, while you're very right, it's important to manage burn rate and manage the business on a day-to-day basis. For a conversation with investors, what's far more important is, what does this company look like over a 3, 5, and 10-year period?
Right.
And
how can my money actually help scale it quickly? Yeah. So, Matt, it's March. Let's go back to March, and a nationwide shutdown is looming, even though we didn't know that in early March. The economic landscape is certainly changing. During that month, as everything changed so quickly, did RZC begin to think about stepping back from or slowing your startup investing like VCs? Did the family office begin to focus more on portfolio? Why or why not on that?
Yeah, so similarly to what we would expect from a management team, we pivoted ourselves. Mm-hmm. Spent probably the first 60 days of the pandemic focused internally on our portfolio companies, understanding how they were going to be able to grow throughout it. It's just, basically creating cash burn models and the like. In addition to that, we've pivoted ourselves and focused less on venture related opportunities and more on distress. These distress cycles come along probably 2 or 3 times in your career. I've already been the beneficiary of one in the 2008, 2009 timeframe. This will be the second one. And so you really need to take advantage of these opportunities. And so we've pivoted and are really exploring setting up partnerships with distress-oriented companies where we could come in and provide capital, like the Bass family did for a Texas company, Bluebell Ice Cream, in your neck of the woods, years ago, related to a listeria outbreak. So we've really repositioned our business to be able to provide capital to unique opportunities like that ourselves.
And that's the exciting thing about having a family office. You have that ability to really pivot, whereas VC funds have to stick with their investment thesis. I mean, they can make some changes, but that is something that's unique to your firm.
Correct. That's the benefit of our family office, is we do have for nimble capital.
Yeah. So along those lines, you've mentioned a little bit of the change in direction, but for startups particularly, how has this crisis changed what RZC seeks in terms of deal flow and considers investing in? Are you still looking at startups? Has COVID-19 temporarily changed your investment thesis in this asset class, or the type of companies into which you're willing to invest?
I would say it hasn't changed our thesis per se. We're still actively looking at venture-related opportunities. We are not prioritizing them over some of the larger check size opportunities in the distress world.
We can't hear you.
I'm telling you, this Dell, Claire.
You need headphones.
We're not. We have not changed our thesis related to venture-related opportunities. We are not prioritizing them above some of the more distressed-oriented opportunities that are larger check size opportunities for us. So while our thesis hasn't changed, we've just deprioritized them. We've still actively pursued some. We have gone back to the well on certain opportunities that we really liked prior to the COVID environment and gone back to those companies and explored conversations with them about current rounds, whether those are down rounds or at more attractive valuations to the investor base or come with new structural enhancements that we would prefer. So we're definitely still seeking opportunities in that space. In fact, we've put out a term sheet recently on a hospitality venture-related opportunity at a significant discount to where it was just 120 days ago, but still very, very much pursuing those kind of opportunities as they come up.
Yeah. And that's something that's really interesting about investing in the downturn is you have that opportunity to explore companies at a valuation you wouldn't otherwise have a chance to get into. And it's certainly a risk to go after something in a sector that's down so much, but you're banking on it coming back, right? Yeah.
Absolutely. And we're putting in structural enhancements, milestone-based capital, i.e. the company has to prove that it's going to be able to hit its goals and objectives over a shorter or near-term basis in order to get subsequent capital deployments from us. So all the things that you would kind of expect an investor to try and do during a downturn like this, where there's a lot of uncertainty in the market, as well as what the demand curves might look like over time.
So, Carter, plenty of investors and founders have heard of rounds falling apart this spring. And we've also, what comes along with a downturn and difficult conditions for entrepreneurs is investors who will take advantage of that and put out terms that are, and sometimes egregious, unfortunately, but terms that the entrepreneurs might be less comfortable with. How concerned were you that your round would close or that you might lose some investors as we were getting into the beginnings of the pandemic? And realizing you closed basically in March, it was announced in April, but did that come into your thinking at all?
Not tremendously. I've got a few thoughts there. And yeah, we closed on a Friday afternoon as everybody was packing their boxes up to go home and work remotely. And literally at the
lucky timing.
Yeah. And so, what I would say is if the, to put myself and Matt in in some of those hypothetical situations, one, we were comforted that we had the right partner, the right investing partner, and didn't feel like there were no fundamental business changes occurring that would justify a stair step down in valuation or a press in valuation. And in fact, ultimately, we've been a net beneficiary of economic unease as a company.
Mm-hmm.
So anything would be me grinding against Matt. But the reality is that we had an agreed upon situation, and I, what I would say, and I, at that time, there was no risk or concern in the back of my mind that would occur. Because again, I know Matt, and we have a lot of trust established between us, as I think managers of businesses should have with their investors. And what I would say is, if that were to occur, where you were in the final hour, and the investor just looked to simply exploit the current market environment to press you, you might want to think twice if you have the optionality or ability. You might want to think twice about spending the next 5 years of your life, sitting next to that investor.
Yeah.
Because, again, if there's a fundamental business change, and they've got all the reason to do it, as Matt has suggested in a hospitality business where clearly things have changed. In our business, if anything, there's a fundamental business improvement as a result. Just saying, hey, I've got a new excuse. I'm going to come hammer you on valuation. That might not be the person you want to be locked arms with for the long term.
Indeed.
Absolutely. Would mirror a lot of the same comments. We spent to Carter's comment earlier on in this conversation, we spent a year getting to know Carter, getting to know his team, because
before that 8-month period of,
pretty much as soon as I moved to Northwest Arkansas, I got introduced to Carter, had an early conversation on AcreTrader oh, that's interesting. A little bit too early for us at that point in time, but would love to follow it. And Carter's a super smart guy, far smarter than me. So figured friends in Northwest Arkansas and spent a lot of time just getting to know him. He introduced us to his team. We kept on seeing him bring in more and more talent into the organization, and he's built something really cool. And we invested behind it. And so we spent a year developing that relationship and curating it. Why would we go trump it, so to speak, for not that much money? And, we're investing in a team. The last thing you want to do is fracture a relationship.
Yeah. Great points, both of you. So, Matt, how do you see startup investors prioritizing things differently? You certainly have mentioned some changes. I'd be curious what you know of other investing colleagues, more focus internally on existing portfolio, less investing, pivoting to different sectors. What are you seeing?
Definitely some pivoting to different sectors. I think most people are trying to protect their downside and still provide unbounded upside. So that comes through structural related issues, i.e. your liquidation preferences might be more than one times. They might be more like 2 or 3 times. Mm-hmm. Downside, they might have super priority over all the other preferreds that might have already came into that capital structure. I'd say it's more structural related stuff, protection of the downside. Capital is obviously risk averse at this point in time. It's easier to invest in companies that you already know, follow on capital versus new investments. I know there's some firms out there that have closed several deals already in this virtual environment, having met a founder or an individual. I'd say we'll probably struggle to do that, as kind of evidenced by the fact that we spent a year getting to know Carter. We'll certainly.
That's a lot of Zoom calls.
That's a lot of Zoom calls. And so I think it's going to be a unique environment where capital is deployed more into the winners today that already exist to further their growth and take more market share versus kind of seed stage. And I think it's pretty evident in the early facts and figures that you showed to us. Mm-hmm. I think 15% decline in year-to-date VC capital deployment, but in the seed stage stuff, it was 50 to 60% off, which makes more sense to me.
Yeah.
The other point I would make on that is we're seeing the same thing from a fund-to-fund perspective.
Mm-hmm. Yeah, the LPs are doing that as well.
Yeah, the larger funds are getting more and more commitments, and the smaller ones and first-time funds are not getting funded at this point in time.
Yeah. Yeah, we've seen that at Kauffman Fellows as well. Carter, let's see what we can do to help entrepreneurs during this time. We don't want to be all doom and gloom, but it's a tough time to raise, right? So even though you were further along, had landed your lead investor, were basically closing as everything was shutting down. First of all, how do you think raising a round during a global pandemic and recession is different from raising at any other time? I think you said it's probably pretty similar. But what might you do differently if you were starting fundraising now? Kind of walk us through what are the points you would do. Obviously, with RZC, you spent a year, 18 months longer getting to know each other and getting to closing. So there's largely a relationship component here with investing, working with investors. What's your advice for entrepreneurs who are trying to raise a round now?
Yeah, I think it's probably pretty similar to what it would have been 6 months ago, which is, oh my God, I underestimated how hard that is. It is. It's just. I don't know how to describe it best. I like everything always ends up taking longer and it's harder than you expect it.
Well, rubbing your forehead and doing this, it tells us a lot.
and I mean,
just the body language.
Just the mechanics and the technical aspects of it. So first, the advice would be prepare well in advance and practice the pitch on a lot of people.
What do you prepare? What do you need to have ready as an entrepreneur?
Yeah, I think a good explanation to how your business works and asking critical people to come knock holes in it, right? If you're very early stage, you got holes in your business, no matter how great you think it is. We still have plenty of them today. But I think what's important is identifying those weak spots and being upfront and highlighting those to people. That having that intellectual honesty with anyone looking to invest in your business is really important. So preparing yourself for those conversations, preparing a business overview, and lining up lots and lots and lots of calls and conversations with investors. I've seen stats; it's something like a 5% conversion rate from call to the hey, that person invested.
If that.
Yeah, if that. And
yeah,
I mean,
I've heard of one in 100.
Maybe right, and I think
Yeah.
we were very lucky in that regard. But regardless, getting the intro calls all set up and identifying, okay, here are the 5 real firms we want to work with, narrowing that down then to the best fit on either side, and then the mechanics, right? So Matt and I have a fun relationship, a good relationship, and we're like, all right, here's how it's going to work. We do a little bit of wrestling around. We get the basic things settled. We're like, cool, let's go close it. And then we got lawyers involved, and they're like, well, what happens if his grandma bumps her cart at the shopping center into your dad's car? Like these
Key-man insurance.
These scenarios you never dreamed of, and we fight about these things, or the legal teams fight about these things and rack up fees over the course of months doing it. And that was something that I was just, as a first time really going through that process of an actual equity round, I was pretty surprised by the difficulty of that. And so, again, just preparing, reading, researching, studying, and then just no matter how much that you do, plan on it taking you a lot longer than you expect.
What resources did you find? And I realize you have an investment background, not in startup investing, but you understand other asset classes really well, right? For entrepreneurs who perhaps don't have that finance background, and for yourself learning about early stage investing and fundraising, are there resources that you found particularly helpful?
Yeah, there are a number of books out there, both things like Traction and sort of entrepreneurial guidebooks, and then there are books dedicated to raising capital. I would call those okay, but blogs. I know it sounds ridiculous, but like Y Combinator puts out really great information about here's how a conversation goes, and then like what is a preferred share, what's a preferred all these various things that you probably haven't thought a lot about, but are really important. Being prepared and studying on those is a big deal.
The lingo in VC is interesting. Coming from a growth and buyout perspective, it's meat and potatoes. I feel like there's been this allure created around VC through acronyms and through various adjectives that are difficult to understand, and you've got to be in the crowd to get it.
And I think that's certainly across angel investing and VC. We're kind of saying VC, which in some cases can encompass all stages of types of investors, but in this asset class, the lingo is tough. I think there are, for those entrepreneurs watching the recording or who are here live today, there are 2 resources that I particularly recommend to entrepreneurs. One is a book called Venture Deals by Brad Feld and Jason Mendelson. They also put on a course twice a year that's hosted by Techstars and the Kauffman Fellows, and that is a free course. You can get access to Brad Feld and Jason Mendelson through that course and take it with fellow founders or other investors. The second is a small, dense book. It's not particularly fun reading, but it is pretty important. And that is Valuations and Term Sheets by Alex Wilmerding. I think that's a really good book for founders. And the reason we're talking about this piece of it is, Matt, Carter, you would never want to go into a negotiation not understanding those terms of venture capital and angel investing, right? That's understanding how you're selling, what you're selling of your company, the various aspects of it. I can't imagine going into that without knowing that. Were there any pieces that you didn't know or that surprised you?
I think, yes, Matt introduced me to some new acronyms. And I think I want to circle back to this conversation because we talked about resources, but by far and away the most important one was humans, right? Talking to other founders that have raised capital, speaking to people like Jeff Amorine at Startup Junkie here locally, and just asking every person you possibly can for advice is way better than books and blogs, for sure. Because a lot of these other folks have real life experience in these scenarios and can tell you, the good, the bad, and the ugly.
Yeah. And I think, Carter, you, as a pretty experienced founder at this point, already know this, but many first-time entrepreneurs in particular may struggle with this concept that, yes, you need to ask advice from a ton of people. You also need to know how to filter that advice. Because particularly when you're asking advice from investors who are in kind of a powerful position, if you will, compared to you seeking the funding, you can hear all kinds of different things and things that'll sound like they are absolutely set in stone, that you need to change this. And you have to put the filter of, your business best, and your product and your team best, your market. Have you had to face that yourself when seeking advice? That filter?
I think that's fair. But you always have, we all have innate biases, right? And we don't want to hear things that we don't want to hear. Or
we don't want to hear our baby is ugly.
Yeah, and I would actually encourage to lean in on those things. When someone tells you something uncomfortable or something that's not something you've thought about a lot, that's actually where you should look. And so filter out the repeat stuff, sure, but really go investigate those difficult conversations. And actually, I did find you were talking about investors and VCs giving me different feedback. I found that really helpful because they look at hundreds of companies to invest in, and they'll tell you, hey, here's what I think is bad about your company. Even if it's not, that the other VCs are going to see that same thing and think it's bad. So you better go ahead and address that and have a better. And likewise, they each have opinions on valuation and on terms and the gritty details that are all worth hearing.
Thank you both. We are getting close to 10:45, which is when we will open it up to Q&A if the folks in attendance have questions. Just a reminder to those of you here live, you're welcome to drop a question in chat or raise your hand. Nate and Jeannette, who are our hosts for the Zoom webinar today, will help us get those questions answered. I'm going to go back to Matt and Carter while we wait to see if we have any questions from folks. Matt, you mentioned the challenges of virtual investing. You invested in AcreTrader. You are investing in the hospitality company. How much of that work with the hospitality company has been virtual? And I should preface this by saying virtually every VC I know is having to make a significant adjustment, and angel investor, a significant adjustment to this kind of online, not in-person world of investing, because there's a trust factor that has to be built. And can you do that online? And as a partner in a firm that does all of our investing online, I know it can be done, but it's tough for those who are not used to it, right?
It can certainly be done. Others have already done it. Sequoia, I think I read, is close to 15 deals during this pandemic, all through virtual investing, if you will. So it can certainly be done. There is a trust factor and a rapport that, in a assessment of body language, that you can really pick up on in person. For instance, if we're looking at a manufacturing deal and I walk through the plant with the CEO and all of the employees look at the face, or he doesn't know the names of his individual employees, I pick up difficulties, right? And I'll probably ultimately pass on that because it's telling me something about the culture within that organization that I really don't want to be a part of. I can't pick up on that in a virtual environment. So we're trying to curate ways to be able to pick up on those same subtleties and cues that you otherwise would be able to in a physical world, but in a world. And so it's interesting to see how it plays out. We're in the midst of diligence on a handful of opportunities right now. in various stages, and it's all been in a virtual environment. So we'll see in 30 or 45 days how I feel about those diligence processes playing out.
We'll have to follow up and have a second session. Yeah, that reminds me a little bit of an investor who was presenting to Kauffman Fellows one time, and he said that the number one way he has to kind of evaluate the personality of a CEO, whether he wants to invest in him or her, is, believe it or not, taking a ride in their car. He wants to know what their car looks like. I thought it was an unusual approach, but that's probably pretty tough during a pandemic, right? So, Carter, we talked about the term sheets being pulled and renegotiated. You didn't have to adjust your expectations around the amount of additional stake or changes in terms. But how might you have approached that if you had to? How flexible do you think entrepreneurs should be when raising during a time like this, having to drop valuation and perhaps change terms?
I think entrepreneurs should always be flexible around, and I don't mean to provide a coy answer, but the partner really does matter, right? And we, while there was optionality out there for us, we were by far and away excited to truly partner with RZC and with Matt and the team there for a long list of reasons outside of just here's some money. And so, I think that that really should influence the conversation more heavily is who are you partnering with and what is this firm doing to help your business beyond just valuation. Flexibility should always be there to get the right people. Again, if somebody squeezes you for inappropriate reasons or you feel slighted, first talk to people as always, get advice from other people before making a flippant decision. But if it really is somebody just trying to purely take advantage of you, then that's probably not somebody you want to be in lockstep with.
To go a little deeper on this, Carter, what terms do you think one would need to be flexible on during this time?
Valuation and contract terms, right? Both are equally important. If anything, contract terms may be more important, right? Making sure that there is flexibility in your business and that you haven't, because at the end of the day, the people inside of the company are going to usually, be well informed to make decisions, and perhaps more so than, especially a far distant VC that's not really paying attention. And so, making sure those terms allow you that flexibility is important. But again, the current environment, it sucks. It's not good for anyone, right? No way to go around that. But you should always be flexible in what your ask is and how you go to market.
So, Matt, kind of following up on that with Carter, what specific terms can you imagine changing for this time during this crisis?
Definitely, when capital is precious, like it is in this instance.
Can't hear you as well.
When capital is precious, like it is at this instance, obviously the investor has a little bit more say in these kind of opportunities than we did in the past. Definitely 24 to 36 months, arguably the past 5 or 6 years.
Yeah.
Across all investment life cycles, from venture through growth equity and buyout, just as you've seen multiples increase. So I think the two things that I would be focused on right now are downside protection and trying to create unbounded returns. So I think you're seeing a lot of participating preferred type structures out there where it's a super priority structure, preferred investment, where I get my money in a multiple back and then I participate in all the upside with other investors. That also, if the existing investor base as well as the management team believe in their valuation and you can't necessarily get to that same valuation, it's a way to structure an investment that can win on both sides to the extent that the management team and the existing investor base still really believe in it. And it's a way for them to prove it by allowing a preferred investment to come in there. And there's also some IPO registration right related issues that are pretty important at this time of day. So
Yeah.
they're all structural related, downside protection type stuff.
Sure. And the IPO is making sure that the investors have at least some share, if not ownership of that, should the company fail, right? So that they can recoup something. Yeah, that is something we've seen a lot in angel investing, because IP in some cases with early stage companies is, aside from the team and maybe some product at that point, it's really the only value in the company when it comes down to it. When it comes to selling something.
In that similar vein, and I mentioned this a few minutes ago, is downside protection. It's goal-based investing. Sure, we'll commit providing capital to the extent that you hit these metrics and goals that are, mutually agreed upon by the management team and ourselves. And it really forces a conversation about whether management and the existing investor base really believe in those goals or objectives, or they're just looking for kind of dumb capital, if you will. So then it's more downside protection oriented stuff for an investor like us as well.
And we've gotten into the weeds a little bit on terminology. For anyone who didn't understand some of that, I'll refer you back to that little dense book, Term Sheets and Valuations by Alex Wilmerding. It's a great one. So for follow-on rounds into your portfolio companies, your existing companies, how much leeway are you giving them right now, Matt, or would likely give them? Are you softening expectations around where they should be at this point in time in their company cycle?
Earmuffs, Carter. Earmuffs.
Close your ears.
It really depends upon the opportunity. In our investment in AcreTrader, one of the value props is that this is a less volatile asset class, and we feel like we've accelerated some of the funnels on this dual-sided marketplace because of that. Mm-hmm. So with respect to an AcreTrader, no, I don't think we need to soften our expectations. Perhaps we even need to reset them to the higher end. On other investments that we have, the demand curve has hit a downward trend that you otherwise really can't fix at this point in time. The only thing that you can do is try and restructure your cost base to be able to capitalize on it in the future. So it really depends upon the investment. There's no real rule of thumb that I would say. We're realists and pragmatists. So it really depends upon the opportunity and the investment that we're specifically talking about.
Thanks, Matt. Carter, for this During a Crisis virtual series, we discussed pivots last week, as I mentioned earlier. Internally, how have you changed your focus due to the pandemic, the global pandemic and recession? And specific to your seed round, how have you had to adjust the use of funds at all that you originally planned from this raise?
We are lucky in that from a business perspective, a business model perspective, and capital deployment perspective, not much has changed. If anything, we're seeing a little bit of we are seeing a lot of acceleration in demand on our platform. So we actually feel very positive and excited about the coming year for AcreTrader. The challenge has been communication. And that's something that I, continuously, despite efforts, it's just so difficult to get it right, to make sure that every constituent within the company is consistently up to date with what's happening across. In our case, we're basically two separate businesses, a supply side and demand side of the marketplace, and making sure there's consistent communication between those and right setting or level setting of expectations. So without a doubt, that's our big challenge has been created by COVID and not being in the office together every day. And so we've spent a lot of resources, which is money, right? When we do a 30-minute stand-up call every morning for everybody to get on and discuss the day and the problems and blockers. That's 30 minutes of everyone's time. That's real dollars. And so we're having to deploy capital, if you will, to that unforeseen issue.
But by the same token, wouldn't that just be replacing the hollering across the room and interrupting work, and if you're in person?
Yes, it would. And in fact, the hollering may take a little more time.
Yeah, interrupts everyone.
Yeah, the communication, level of communication, real-time feedback that's provided by that is also more valuable.
Sure.
So it is something that
it's a trade-off.
We do dearly miss, is just being in the office and barking at each other.
Matt, communication, Carter just touched on this. What is your expectation of communication from your founders in your portfolio? What advice do you have for entrepreneurs listening to this recording or here live today?
Your board and your board and your investor base is really only going to be as good as you allow them to be. If you do not engage in communication and you're not providing an outlet to discuss what the problems of the business are, you might never find a solution. To your point earlier, part of the benefit of bringing on outside capital is that you're bringing in experts, advisors, really smart people to help you think about some of those bigger problems, whether strategic or tactical. And if you're not leveraging them, then you're really only doing yourself a disservice. So Carter and I speak at least once every 2 weeks. I'd say every time that there's a platform or a farm that goes online on the platform, we're making side bets about how long it takes to fund, which we've all been stoked about recently. And then we have monthly and quarterly board meetings. So, we have a really good communication style, some of it ad hoc, some of it programmed. And I always have an ear if Carter needs it.
Have you ever, Matt, experienced having an entrepreneur who does not communicate well? For instance, I know plenty of angel investors who don't hear from the entrepreneur they founded for months and months and months. And then all of a sudden the CEO and founder comes back and says, we're ready for a follow-on. And really? I haven't heard from you in months.
It's almost like underwriting a completely new deal in those situations because there is rapport or no cadence of communication with the founder to really understand what the story is and what's going on in the business. So yeah, we run into those opportunities and those kind of situations all the time, and it really is like underwriting a new deal for us because
and probably makes you think twice.
It does. It does. Absolutely.
Sure. So we have a couple of minutes left. I want to make sure we end on time, respect everyone's time. Based on your personal experiences for each of you, and we'll maybe give you each a minute for this, what advice would you like to share with other entrepreneurs and investors in these unique times of global pandemic unrest and recession? Carter, let's start with you.
Yeah, I think 2 points, which is one Matt just made, which I want to reiterate. You're only as good as the people you surround yourself with, and so making sure. I don't need to expand on that. We understand what that means, but it's really, really important. And then specific to the current situation is there's almost no such thing as too much communication. And to Matt's point, have programmatic communication established with people on your team, with stakeholders in your business, and with advisors, so that you're making sure you follow up, and then always have that ad hoc as well, where you hop on the phone or Slack or email and just keep the communication lines, force them wider than you would otherwise think about. Yeah,
great advice. Thank you, Carter. Matt?
The only thing I would add to that is find out how this is going to make you focus.
Missed that last part. And if you would, Matt, from the investor perspective, share both your advice for entrepreneurs and for fellow investors, perhaps. We might have angel investors who are new to the asset class.
Yeah, so for an entrepreneur, I would say everything that Carter just mentioned, which was kind of a reiteration of some of my prior comments, but then also find out what it is that you're going to focus on and how this is going to make you better, more efficient as an organization. What product or solution or service you're going to provide to your end customer that's going to be even better because of this COVID situation. From an investor standpoint, be patient.
Yeah.
That's the biggest point of advice I could provide at this point in time is be patient. There's certain things that are out of the company's control. There's certain things that they can't control. Measure and monitor them on what they can control. And make sure that they're trying to, work through the things that they can't control and put up stop gaps. But I'd say be patient at this point in time.
Great. So that wraps up our Raise During a Crisis discussion. And I want to thank everyone who joined us live and who's watching this on pre-recorded video. And especially a big thank you to Carter Malloy with AcreTrader and Matt Tarver with RZC Investments for joining us. And of course, to StartupNWA and the Northwest Arkansas Council for hosting us. we will look forward to seeing everyone next week for Invest During a Crisis with our special guest, Susan Mason from Aligned Partners in the Bay Area. Thank you so much, everyone.